Another day, another story. Business cycles refer to the pattern of fluctuations in economic activity that occurs over with the passage of time. These cycles are characterized by stages of expansion, recession, and recovery. Business cycles are a normal part of a capitalist economy and are driven by a range of factors, including changes in consumer spending, investment, government policy, and global economic conditions. Recession is the phase of the business cycle where economic activity slows down, and output and employment decline. During a recession, businesses are less profitable, and consumers have less disposable income, leading to a decrease in demand for goods and services. Recessions are usually accompanied by a decline in consumer confidence and a rise in unemployment. In severe cases, recessions can result in a contraction of the economy, a drop in the stock market, and a financial crisis. Example of a severe recession was the Great Recession of 2008-09. This recession was triggered by the collapse of the housing market, which led to a widespread decline in asset values, including stocks and bonds. The recession resulted in high levels of unemployment, declining consumer spending, and a contraction of the credit markets, making it difficult for businesses to obtain financing. Recovery is the phase of the business cycle where economic activity begins to pick up, and output and employment start to increase. During the recovery phase, businesses become more profitable, and consumers have more disposable income, leading to an increase in demand for goods and services. Recoveries are usually accompanied by an increase in consumer confidence and a decrease in unemployment. An example of a recovery was the period following the Great Recession. The recovery was initially slow but gained momentum in the years that followed. Businesses began to invest in new projects and hire new workers, and consumers became more confident in the economy, leading to an increase in spending. Economic growth is the long-term trend of economic expansion. It is measured by the growth in gross domestic product, GDP, which is the total value of goods and services produced in an economy. Economic growth is driven by factors such as technological progress, innovation, and improvements in productivity. An example of sustained economic growth is the period of post-World War II economic expansion in the United States. This period saw a surge in economic growth as the country rebuilt its infrastructure and invested heavily in technological innovations. The period also saw a rise in consumer spending and an increase in the standard of living for many Americans. Business cycles are a natural part of a capitalist economy and involve fluctuations in economic activity that occur over time. These cycles are characterized by stages of expansion, recession, and recovery, and are driven by a range of factors, including changes in consumer spending, investment, government policy, and global economic conditions. While recessions can be severe and have long-lasting effects, recoveries and periods of economic growth can help to restore confidence in the economy and improve living standards for citizens. Thanks for watching.